Crude oil just flipped from oversupply to war pricing overnight. And if one shipping lane gets disrupted, we are not talking about $80 oil. We are talking about panic oil. 100, maybe 150. The next 72 hours will decide everything. Here is what just happened. The United States and Israel launched major strikes inside Iran. Iran responded with missiles across the Gulf. Energy infrastructure is now at risk. Oil tankers paused, and traders are no longer pricing supply and demand. They are pricing fear. Before this, Wall Street expected too much oil in 2026. Now the market is asking one question: how high can crude go if this becomes a regional war? WTI was sitting in the high 60s, Brent in the low 70s, already moving on the first strike headlines. But when futures reopen, we could see an instant $10 to $20 gap higher, not a slow move, a repricing. Now here's the key part: oil does not move because of wars. Oil moves because of supply disruptions, and the most important choke point on Earth is the Strait of Hormuz. Roughly 20% of global oil flows through that narrow waterway. If it stays open, oil spikes and then cools. If it gets disrupted, the entire global energy system gets repriced. Even a one-day disruption can send oil into triple digits. This surprised traders because just weeks ago, analysts were calling for $56 to $60 Brent for 2026. Those forecasts are now useless. Let's break down the three scenarios the market is watching. Scenario 1: limited conflict. Shipping continues. No major infrastructure damage. Oil jumps to around $80. Risk premium fades. Market stabilizes. Scenario 2: prolonged war. Iranian exports drop. Iran produces about 3.3 million barrels per day. Losing even 1 to 2 million removes the global surplus. That pushes oil into the $90 to $100 range. We move from oversupply to structural tightness. Scenario 3: Hormuz disruption. This is the nightmare. Not even a full closure, just tanker attacks, mines, or insurance spikes. Shipping slows. Freight costs surge. Barrels get rerouted. That is how you get $120 to $150 oil. That is panic pricing. Now here's why this matters for the entire market. If oil hits 120, US inflation could move back toward 5%. That means no rate cuts, higher bond yields, pressure on stocks, stronger dollar, higher volatility. Oil becomes the macro driver. Most investors are missing this. The real story is not the spike, it is the new floor. Before the war, oil had a bearish floor near 60. Now the floor could shift to 75 or 80 even if tensions cool. That is a structural change. What about OPEC? Yes, Saudi Arabia and the UAE have spare capacity, about 2 to 3 million barrels per day, but that only helps if shipping lanes stay open. If Hormuz is disrupted, extra supply cannot reach the market. Supply exists, but it is trapped. Could the US release the Strategic Petroleum Reserve? Yes, but that is temporary. It does not fix a shipping choke point. It is a short-term band-aid. Here is another key factor. Iranian oil mostly goes to China. If those barrels disappear, China has to buy from the open market. That tightens global supply even more. Even without a full closure, war risk insurance alone can push oil higher. Shipping costs rise. Delivered crude becomes more expensive. Fear becomes a price driver. So what does this mean for investors? Energy stocks benefit. Producers generate more cash flow. Oil services gain. Refiners can outperform short-term. But airlines, cruise lines, trucking, and consumer stocks face margin pressure. Higher fuel equals lower profits. If oil stays above 90, inflation expectations rise, rate cuts get delayed, equities face headwinds, and volatility spikes. Oil becomes a macro shock. Now watch these catalysts closely. Retaliation headlines, tanker traffic through Hormuz, OPEC production decisions, SPR announcements, energy infrastructure damage. Each one can move oil $3 to $5 an hour. Short term, we are trading headlines. Medium term, the outcome depends on escalation. If tensions cool quickly, oil spikes and fades back to the 70s. If the conflict drags on, we live in a $90 to $100 oil world. If Hormuz is disrupted, we enter crisis pricing. Long term, this changes the narrative. The market was pricing energy abundance. Now it is pricing energy fragility. That means a higher geopolitical premium for years. Final takeaway: oil is no longer trading on inventories. It is trading on missiles, shipping lanes, and political risk. And the next 72 hours will decide whether this is a temporary spike or the start of a structural bull market. Do you think oil hits $100, or do we see a shock move to 150? And which energy stocks are on your watch list right now? Comment below.